Hi there. In this short business topic video, it's going to provide a brief introduction to the format and structure of one of the financial accounts of a company, the balance sheet. Now, don't forget that the balance sheet is one of the three main types of financial account produced by a business. Let's just briefly look at the three to see how it fits and how it differs. The income statement is the key way that a business reports its performance, its financial performance in terms of income and costs over a particular period of time, usually a year. The balance sheet is different. This doesn't deal with income and cost, it deals with assets and liabilities, and it's a snapshot at a particular moment in time, for example, at the end of the financial year, of what the business owes or is owed, the assets and the liabilities. And lastly, the cash flow statement is a historical record of how cash and other liquid funds were generated or were brought into the business and how they were spent. So it shows the movement in cash over a particular period. So let's focus for the rest of this short video on what the balance sheet is and what goes into the key categories that you'll see on a typical balance sheet. But don't forget, the balance sheet is just a snapshot taken at a particular moment in time, usually the last day of a month or the financial period, and it shows and tries to summarize what the business assets are. Assets are what the business owns or is owed by people to the business, and also what the liabilities are, what the business owes or owes to others. Now, because of a thing called double entry bookkeeping, the balance sheet will always balance. That's why it's called a balance sheet. You don't need to worry too much about why it balances, but it is important to understand what goes on the two sides of the balance sheet. Firstly, on the left-hand side, let's have a look. Well, there are two positive numbers to add together. Firstly is the total for the book value of the non-current assets. We'll have a look at what those are in a few seconds. We add to that the value of the current assets of the business. So you can see there's two types of assets there, non-current and current assets. So we add those two together. And then we take away from that the current liabilities of the business and the non-current liabilities. So we add together the assets, we take away the liabilities, and if you put them all together, add them all up, positive, take away the negatives, you should come up with a figure for net assets. On the other side of the balance sheet, the net assets will equal the share capital invested in the business together with the accumulated reserves, in particular the profit of the business. Add those two together and you come up with a thing called capital and reserves. Now, so don't worry about why these two things balance. They always do because of the way accounting is performed. But the important thing is to remember that the net assets are always supported by the capital and reserves. Let's just look briefly then for the rest of this video at what goes into those four items on the left-hand side there, those assets and liabilities, just so you get a flavour for what the main parts of the balance sheet are. Starting with non-current assets, these include the land and buildings. If they're owned by the business, that would include the value of the land and maybe the cost of the buildings. Of course, don't forget that you would also have to allow for depreciation, any fall in value of those land and buildings, along with the net book value of any fixed assets held in the business, for example, plant, machinery, computer systems and the like. And also you're allowed to include in non-current assets the value of purchased goodwill, where you've bought an intangible asset for a particular price, and you can include that asset in non-current assets at its appropriate value. You add all those three together and that comes to the total for non-current assets. Current assets you'll almost certainly come across if you've been looking at liquidity ratios or working capital. And the three main categories of current assets are firstly cash, of course, cash held in the bank or cash balances held in the business. Next, what are known as trade debtors, or you sometimes see this shown as trade receivables. What these are amounts owed to the business by customers who've been allowed to buy on credit. So trade receivables, trade debtors, and of course you may have used that number if you're looking at the receivables days figure. And the third main type of current asset that you'll come across in the balance sheet is inventories, or sometimes also known as stocks. There are other types of current assets like prepayments and other debtors, but those are the three main types of current assets that you'll end up using on the balance sheet. Now those are positive. Of course, there are some negatives here which we need to account for. Firstly, the current liabilities, and these are the amounts that are owed by the business that it will have to pay sometime in the next 12 months. The key ones there are the trade creditors or payables. These are amounts owed to suppliers or other people who've allowed the business to buy on credit. Of course, if the business has any short-term borrowings or debt that maybe need to be paid back within the next 12 months, that would be included here. And you would include in the short-term borrowings any balance of a bank overdraft that the business has. And lastly, also a thing called accruals and provisions. This is where the business just makes an allowance or an accrual or provides for known costs, known liabilities that it believes it will have to settle in the next 12 months. Add those all together and you come to the total for current liabilities. And finally, non-current liabilities. These are the liabilities that are not due to be paid in the next 12 months, but still need to be reflected in the balance sheet. So they feel like long-term liabilities, amounts that is owed by the business. So for example, that might include any long-term borrowings, perhaps a bank loan which is not yet due for repayment, maybe more than 1 year's time, maybe between say 1 and 5 or 10 years time. It could include any other kind of borrowings or debt that the business has undertaken that it doesn't need to pay back in the short term. And also any other provisions or likely liabilities that it wants to include in the net assets, perhaps a possible claim against the business or some other kind of liability that it needs to provide for. That will be included in non-current liabilities. Add all those four together and you come to the net assets in the balance sheet. Now don't forget, on the other side of the balance sheet, you've got share capital and accumulated profits. But I think the most important thing is to remember what goes into the different categories of net assets there, those four things there listed there. That's been a brief introduction to the structure of a balance sheet.